we're going to jump right in here. I'm going to very briefly introduce myself because I always forget to do that. I'm Vonetta Young, an investment readiness and fund formation advisor, founder of Vonetta Young Advisors, and welcome to the Emerging Manager Roundtable. So we've got Lori Gleeman here today, founder of Soul Equity Solutions, and we are talking about building your team, as I so cleverly came up with the other day. Top quartile funds start with top quartile teams. And we really can't stress the importance of having a really strong team as you are building your fund. So I'm going to let you read Lori's bio on our social media. So please do go to the VY Advisors LinkedIn page or our Twitter page or our YouTube channel and subscribe, please. So we're going to jump right in. Lori, great to have you. Thank you so much for being here. I think I want to start with like a really sort of foundational question being, when it comes to starting a firm for emerging managers, they're dealing with a lot of different things. They are building a firm, meaning they're building a company. They're also doing deals, they're juggling marketing. When is the right time for them to think about building their team?
In my opinion, I think the right time to start thinking about building your team is from the very beginning. I think it should be a part of your business plan in determining what kind of firm you have in mind that you want to grow for the future. What is your business plan? And of course, I'm imagining if you're starting an emerging fund, you are most likely want growth. So I think there's no time and the very beginning of your firm to wrap your head around what your plan is and what kind of growth you have in mind and how big you want to be. Do you want to stay boutique? Are you looking to really grow? And then you can start formulating a plan, a hiring plan. And I can elaborate on that. I'm sure you have additional questions.
No, and I think that it sort of goes to the importance of thinking about, ultimately establishing a culture up front, I think, and sort of, how do you think about not just the number of people that you need, but what's the environment that you're bringing them into and who can help you build that? And so clearly, there are various ways of going about hiring people, putting up ads and things, and, using a recruiter like yourself is a really great way of doing that too. Yeah. And so if they are going to get support to do that, what should they be looking for in a recruiter? And what should that recruiter be bringing to the table for the manager as the other side?
Right. Okay. All right. Wow. Okay. So that's a lot of questions that are bundled together.
You know what I do. I layer them all up. I layer them all up.
So I'll start breaking it down. And if you want to interject, well, if I might jump around a little bit, please feel free to rein me back in. So I'm going to kind of go back to the first question where you're talking about when should a firm start thinking about hiring. I think, and what I mentioned is so true, that obviously the first thing that you're doing is thinking about what is my business plan? How big do I want to be? How do I even begin to start growing? And if that's the case, who is the first hire that I make? What is most important? What I see historically with emerging funds is it's really important for your first hire to bring on an investment professional that knows what they're doing. It's always tempting to not want to spend a lot of money, right? I don't want to put a lot of money out. I'm new. I don't even know how I'm getting this money to even start my fund. And now I have to pay a big salary. But if you really are looking for long-term growth, I think it's critical to bring somebody on board that is an existing investment professional that can hit the ground running in all different directions. With bigger firms, investment professionals are siloed often. You have those people that are doing business development, that are doing origination, they're sourcing deals, they're going to conferences. And then you have those people that are more your traditional investment banking background deal professionals who are doing all of the M&A transactions and structuring the deals. And then you have your operating partners, et cetera, that are doing value creation. A small firm, they can't hire all these different people. So I think the right thing for an emerging fund professional to do is to hire somebody that can do all of that. The most important thing is someone that knows how to structure deals, that comes out of investment banking, that has that background, that's been in that situation before. But combine that with the skills of someone that can also do origination. And really what that comes down to, and that will kind of go into one of your other questions about culture, is somebody that is very personable. Because when it comes to sourcing deals, origination is really a sales role. That's what it is. It's somebody that's very good with connecting with intermediaries, that can very easily make friends with lawyers and accountants and all of the people that are going to bring you business deals. So you need someone that is likable, that is approachable, that's obviously smart and is going to portray your culture, which we'll get to that question, and then in the way that you want to portray your new company. So that person has to represent that culture and structure the deals, and then also sit in with the companies that they buy and assist with value creation. So sitting on board meetings and advising on value creation. So that means that it has to be somebody experienced, somebody with some gravitas about them, that can interact with the intermediaries and knows what the heck they're doing, is not going to come across as too green. So I would say, and at the same time, you're like, well, I don't want to spend a fortune, so how do I match that? I think you need somebody that has a minimum of 4 years of experience, in my opinion. 2 years of investment banking, perhaps 2 years at business school, or maybe 4 years in total of work experience. Could be 4 years out of PE, could be 4 years out of investment banking, but I think a minimum of 4 years work experience. And that's probably a little light, but I think that's the minimum that you could probably get away with that kind of experience.
Can I pause there and say that is such a great point, or should I say it's such a great concrete point. And like, I know people are generally always looking for very direct answers to questions, and I have a habit of not always answering questions directly, mostly because, you know, sometimes one answer doesn't fit for everyone. But I think this is a really great point in saying, you know, if this is this person that you're bringing on, make sure that, oh, I'm sorry, I think someone's, Ryan, I think your mic might not be muted, if you wouldn't mind muting. But to say that, you know, 4 years is a really great amount of experience to get someone started in this, you know, you got a GP or two, bringing someone on with like that direct number, amount of experience is probably going to be a really great move.
Yeah, I think at a minimum, probably more is even better, but at a minimum, I think 4 years of experience is helpful. And I'm curious for I know there are a couple of PE folks here, like what your thoughts on that might be. But again, we're thinking an initial hire and we're balancing salary versus skills. So I can jump if you want to the culture piece. Do you want me to talk about that
David,
next?
did you have a comment or question there?
Yeah, you know, Laura, as somebody who's been part of a startup, 2 startups, my previous firm and my own firm. The other thing I would also add to that is when you bring on somebody, make sure they have the runway space, because you know you're not going to give them a 7-figure salary or you know a market-based salary. There's a little bit of, you know, listen, some of the money is going to come in from the future. You're going to get a little more carry than what you would normally would do. But what I found at my old firm is everybody loves to be entrepreneur. They all say that. Okay. Yeah. And then 6 months into it, when they don't close a deal, and of course they have young families and they need to feed, you can't feed your kids on IRR. You can't feed your kids on carry. That's right. The thing I've learned. Now, somebody like me, it's a lot easier because I have no kids. Okay. So I can go a couple of years without really, you know, worrying about getting a big paycheck in. But that's the one thing I would say, Laura, because a lot of people who I've interviewed now, you know, the reason why I would ding them is because I don't think they have the runway space, okay, especially in New York City, okay, because, you know, if you have 4 years of post MBA experience, chances are you're a senior associate or first year VP, which is a great level to recruit from. Yeah. What is not a good level is, hey, if the next 12 to 24 months, you know, you're getting a below market salary.
Yeah.
would that work for you? Okay, and I found that it doesn't work with a lot of people.
Yeah.
That's a really great point. And I think, Lori, it actually makes me think of something else that, is very sticky, and that is money. And David, thank you so much for bringing that up. My very sort of concrete and basic question is, how do managers even figure out how to pay people? Is there some sort of standard that kind of runs across the industry?
Yeah. So just to be clear, when I said 4 years, I meant 4 years total, not 4 years post MBA. So I do agree with you that someone 4 years post MBA is going to be very expensive and have expectations of making money faster. So there are comp studies out there that different organizations compile. For example, and if you're all, I know some of you are definitely familiar with David Toll, who runs a publication called Private Equity Career News, where he shares information about job openings in the middle market. He has put together and is actually currently in the process of doing surveys of comp studies for people in private equity and investment banking at all different positions, from business developers to investment professionals. When he's trying to survey as many, he's hoping to get like 500 individuals to gather that information on what people are earning, and that's base and bonus and carry and equity, to come up with what is common. And obviously that will vary depending on location. If you're on the East Coast, or if you're, in the Midwest, it might vary based on cost of living. But generally you'll start seeing trends in the market. And I find that too, as a recruiter, every time we speak with someone, we say, okay, what are your salary expectations? And inevitably they'll share information about what they're earning, and we start to see common trends. So a lot of times if a firm says to me, then this is more on the portfolio company side, but if they say, like, I don't know, what does a human resources person make in private equity? I say it will show itself. We will learn as we interview people and we find out what they're looking for. It will show itself in the end of what is the common comp. But when it comes to investment professionals, it's more leveling. They're more like senior associates make this and VPs make this. And that's information that executive recruiter firms like Soul Equity, like my firm, can share. And we can lean on these comp studies that are out there, that exist, that firms put together year after year to show how those trends might be changing. So David puts this together. Some of the larger executive recruiting firms, I think Heidrick and Struggles, I believe, has a recent study that I've seen within the past few months that has come out that shares this kind of data and information to help you know if you're paying fairly or not. Emerging fund managers, you might have to be more creative, and as David kind of referenced earlier, in paying more in the long run with larger amounts of equity if they can't pay as much upfront.
Yeah, no, and that is super helpful. And it brings me back to that question of all the things that a recruiter can help with in terms of even having that information of, where do these things land and where is the comp showing itself? So I do want to come back to that question of, kind of very frankly, what else is a recruiter good for? And how should managers think about, is this the right recruiter to help me get the right people? And how can they be good clients to recruiters too? Because I imagine that helps in them getting the right people too.
Right. So there are different kinds of executive recruiters. There are the very large firms like the Korn Ferrys, the Heidrick and Struggles, the Spencer Stewarts of the world, who've been doing this forever. And then there are boutique firms like my firm, like Soul Equity, where we're a small group and we are extremely personalized and give very closely held attention to our clients. So I think you have to determine what is, and we can come back to this question of culture fit, because you want to align your culture also with the executive recruiting firm that you choose. If you are an emerging fund, for example, you might find that the bigger firms like the Korn Ferrys of the world are not going to pay as much attention to you, because you don't have, they won't be able to get as much work from you in the long run as a boutique firm like Soul Equity. So we like to work, what we do is we partner with middle market and lower middle market private equity firms and offer one-on-one, very personalized attention, and become almost an outsourced talent acquisition group to the firm. The other thing, if you want to compare big firms versus boutique firms is the bigger firms are usually charging administrative fees, which can be upwards of $10,000 to $20,000. So already off the bat, they are charging significantly more money than a traditional boutique firm would charge. So like, in my opinion, that it's kind of makes more sense for a smaller emerging fund to work with a boutique executive search fund that kind of matches their same energy and their same culture. Now, the other thing that's really important is to find a firm that does specialize in private equity. That person will be networked. They're going to know not all, but they're going to know many players in the industry. They're going to understand how private equity works and be able to not only act as a recruiter, but truly act as an advisor as well. And that can extend itself to making additional introductions besides candidates. Like, one thing that we can do as well is introduce service providers, because we're so networked within the middle market that we can introduce candidates. And then if you say, gosh, I really need somebody to do a Q of E and I don't know who to turn to, and the bigger players are like, this happened a lot during COVID when it was bananas and nobody could get a firm to do a Q of E for them because everybody was so backed up. So we can make introductions to firms that we know are out there because we're super networked within this middle market private equity world, that we know people. So that can be like a little bonus that you can get from working with a firm that specializes in private equity. And that's really like in the trenches and in the ground every day, working with people within our universe.
Awesome. That is really helpful too. In the sense that, all the things that make this even more of a people business, and frankly is the reason why I love it so much, are all of these touch points. And so it's the people that you hire to build your team can go even far beyond, and I beyond the people who are working in your firm. And I think that is really, really awesome.
Oh, that's true. And the other thing is when you are hiring, let's say you're hiring like an operating partner, you want someone that has that industry, whatever industry you're hiring them for, if it's industrial or if it's healthcare, that has that industry expertise. So that's what we look for, is aligned industry expertise, because that individual that you're hiring will also be networked in healthcare. Or let's say you're doing a roll up of physician offices, they will know the market. Or if you're doing, in the HVAC space, they're going to so it's only logical to find executives that have that domain expertise that can extend. Not only are they doing the job of, let's say, CFO, but they know players that are in the industry, which could also be helpful if you're doing add-on acquisitions, that they're connected in that universe.
Definitely. So I have one more question. Well, I have plenty of other questions for Lori, but one more in particular. And if anyone else has a question, please feel free to pop it in the chat or unmute. But Lori, you mentioned earlier about culture fit. And I think culture fit, I 1000% agree that it is so important, but it's also, especially now, can be kind of sticky. I think a lot of firms in financial services get flack for being I'm hoping all unintentionally exclusive. It can wind up excluding women or people of color, LGBTQ plus, other people with disabilities, as a result of people kind of, not being like the person they're interviewing with, for example. So what is a more sort of objective way for firms to think about this idea of culture fit, if there is a more objective way of thinking about that?
Sure. Yeah. Well, there certainly is, and there's a more kind of actually scientific way to consider culture fit.
Excellent.
So number one, I'm going to say that the good news is that firms are across the board seeking diversity within their firms. They've realized there's been a lot of studies that show that having people in your firm that come from diverse backgrounds and diverse perspectives adds incredible value to your firm and to the relationships that you're making with the companies that you're buying. That's number one. And number two is also a lot of LPs are requiring it. So even if it's something that a firm hadn't even like considered because they're so busy heads down doing their work, it's now being required of them. So let's go to how do we create culture fit? Well, scientifically, what a lot of firms are implementing and what we always recommend is doing psychometric assessments. And these include, there's different types of assessments. Common ones are the Hogan that people have heard of. One there's called PI, the predictive index. There's one called Watson-Glaser, which is more kind of like an IQ test mixed with a psychometric assessment. But there are individuals that we partner with and that are out there that administer these psychometric assessments. They assess personality, they assess behaviors, they assess leadership skills. They assess how you take feedback, what you do with it, and a lot more. So what we recommend that firms do is do that psychometric assessment, not only on your top candidates when you're in the interview process, but importantly, to assess the internal private equity team, the leadership team. And that will give you a really, and they write these very extensive reports of people's individual behaviors, and then they can layer them together. So I have this person is the CEO. Now I want to hire the COO. How do these people work together? How will they play well in the sandbox? This person has this behaviors, this one has this behaviors. If we put them together, what's the most likely outcome of that culture match? So many firms rely on these assessments during the interview process to determine how that fit will be in the long run. And they are fascinating. I don't know if any of you have ever taken one. I have.
That's what I was gonna ask. Like, how accurate are these things?
They're scary.
Or should I say, like, perhaps I'm just millennial enough to have taken a lot of online quizzes in the late 90s and early aughts and was like, perhaps not. How accurate are these things?
Vonetta, I mean, I'm curious to know the rest of you who have taken these. Like, you can try to fool it. You can try to answer like, this is how the person that I want to be, but they ask you the same question in so many different ways that I had it done, and it was so accurate in a way that it knew me in a way that I didn't even know myself. Where when it was read back to me, he said to me, well, actually, this was the person who actually has become a good friend of mine. You do this, or you behave this way, or you're like this, and I was like, oh my God, you're right. I actually am like that. And I didn't even realize that I was like that, but it's like, it was really crazy how accurate it was. And it's just, we're not as individual as we think we are. That people's behaviors people tend to react a certain way, and it's really fascinating. So that's like an important way, I think, to determine is it an extra expense? Yeah, but who cares? And if you're paying $2,500 to do it, in the long run, it's going to save you a ton of money and not hiring the wrong person and then hiring the right person. So it's very worth it.
So Vonetta, yes, just as a point of reference, we were introduced to it through a limited partner relationship, and they asked us to do the PI, and it was so accurate, it was scary. And,
really?
But what was great was we had been together long enough as a partnership where it confirmed not only our own suspicions about ourselves, but about each other, but confirmed how we interact with one another. And it's now a selling point for us when we deal with LPs. And also we now implement it in every one of our portfolio companies. As Lori alluded to, it helps us understand if we are dealing with a selling shareholder who's staying on or a CEO who's staying on. It helps us understand their working style. And then oftentimes, given that we deal in the lower middle market, we're adding staff and to the management team. And so we get them to participate in the survey, and then sort of able to toggle in and toggle out people. Okay, how would they interact? How would this interact? And it saves us a lot of headache. So for what it's worth.
That That's awesome. And I've met Jabbar and his partner, and even, I can tell in person that they get along very, very well. And it's so, I think to me, that's a great selling point to say, you actually now have, in fact, concrete data to prove the chemistry that people can just see in between you. That is really cool.
Correct. But
And firms
and
do it. Oh, I'm sorry.
no, I was just going to say lastly, one of our selling points is that for prospective LPs, it explains the de-risking of the situation. Yes, we've worked together.
Yeah.
We've worked together for 10 years. We haven't killed each other yet, but and here's why. Because we're complementary and we don't take ourselves that seriously, and we complement one another based on our skills and so forth. So
that's awesome. That is so awesome.
Smartest firms use it. The smartest firms use it, and not only for internal hiring, but I love what Jabbar just said as LPs, as a reference point, and doing the due diligence process. It can be very helpful too, where we're considering buying this company. How is this leadership team? How do they react together? And you can assess those individuals. I mean, that's always like a little bit like tricky, because you don't want to poke the beast if they're considering two different offers, but it's very useful in assessing in advance potential existing leadership teams.
Yeah, and I think that even just using the word de-risking, I think de-risking is the name of the game as it pertains to, emerging managers already having that sort of unfortunate red flag on them as it pertains to LPs, but anything they can do to de-risk even further, and even looking at it within the context of a deal too, that is such a great point. Such a great point. David, you had unmuted. I didn't know if you had anything to add.
Yeah, another reference point, if there was somebody who rallied against hiring an industrial psychologist, it was me. And co-investor actually required it as part of the underwriting process. I ended up having such a great experience that I will not hire a senior level person unless they go through an industrial psychologist assessment. It was so good. It was remarkably accurate, and the advice that we got was so good that if I didn't take it, some of the relationships with my portfolio company CEOs and some of my associates and VPs would have been a lot different.
Wow.
And there were, we ended up at my previous firm bringing the same industrial psychologist to interview all of us. And it was pretty interesting in how the team perceived me and how I, perceived the team. And because of some of the minor changes, I was able to get better output out of people. Okay. And that ended up benefiting the whole firm. So, but before 2014, if you said, "Oh, let's hire industrial psychologists," I keep thinking of like the Tony Robbins type, where we all sing Kumbaya, and then when we go home, we all go back to hating each other. But we spent $1,000 on this seminar, right? I actually, it's the other way around. And so any C-level, E-level executive that I've hired since 2014, you have to go. That's part of the employment agreement, and it's part of as part of the prerequisite that in addition to going to a background check, you have to submit for an industrial psychologist. So I agree with Jabbar and anyone else here who's in two minds about it. My suggestions, go ahead with it, because it will be a huge positive for you and your fund.
Okay. And if anybody needs introductions to companies that do this, feel free to reach out to myself. Obviously, David and Jabbar both have people that they probably would recommend also, but happy to be a resource.
That's awesome. Like, you've got me super excited about this. I kind of want to do one of these tests for myself. And well, sort of sidebar, but also not. I don't know if anyone in the aughts did the eHarmony test on themselves just to see what kind of personalities they would be compatible with. Also, it's pretty scary, and I just love things like this. So I'm gonna have to do this. I'm gonna have to do one of these. Well, what other questions do we have for Lori? Don't be shy, everyone. Feel free to pop it in the chat, unmute. We're very friendly people here. What questions do you have?
So I joined a little late and I apologize, but Lori, at what stage do you think is, I know you started to talk about it earlier, but the hiring process for junior folk, you know, as we are, as I mentioned, in the process of raising a fund, and you know, it's always as David alluded to, you know, the push pull of, can they wait it out until we get to a first close in order to not pay them a king's ransom versus, you know, kind of bird in the hand, but the opportunity to sort of captain their own sort of silo or vertical, if you will. You know, that's the crux that we're, or sort of the odd position that we find ourselves in, is when's the right time to bring those folks on at a junior level, to look a 25-year-old in the eye to say, trust me, kid, you're gonna be fine, to hook your cart to my horse, so to speak.
So just to make sure I understand the question, you're saying at what point should an emerging fund consider hiring a junior associate?
Yeah, and that's we're pre-first close, and you know, my druthers would be to sort of start now in anticipation of finding that right person, so we can bring them on sort of in conjunction with that first close.
I hear you. It's scary, right? You're always thinking, wow, I have to take this leap. I have to pay somebody a salary, and do I have enough work for them to do right away? And can I keep them busy? I think it's worth the risk of bringing somebody on sooner rather than later. I think if anything, it accelerates your growth. And also, not to mention the collaboration. Like, my associate is actually on this call, Samantha, who's you might see her name there. I brought her on, and I have to tell you, the value that she adds to my organization is it's a new, there's no price on it. It's incredible, because it also just creates collaboration, and I think that also can just creates growth just by that value of adding another person to your team. So to me, I think it's more important to do it sooner. So that's my recommendation. I think you don't want to wait until you have too much work, because also there's a lot of onboarding that has to happen that can take a couple of months. And if all of a sudden you do a deal and your first deal is about to close, and now you're bringing someone on and you have to get that person on board and have them understand what you're doing and your style and your systems and everything else, that takes a lot of time, effort, and energy away from what you want to be doing, which is the actual work. So do that now, get that over with, get that rolling, get your processes in place, put this person to work creating value for you, and it's only going to come back to you in the long run. So yeah, my recommendation is just to get going with, just take that leap, dive in and hire somebody.
And I can extend that question, say, John, not to put you on the spot, or even Brian as well, from the perspective of placement agent and kind of LP. When do you all prefer to see people sort of have those more junior team members in place?
I mean, I'll take a stab at it and then I'll let Sajin take over. But I mean, from my perspective, I think the sooner the better if they're skilled. I mean, if they're experienced and if they add to the story and they add credibility to the firm, it's important. Personally, I'm not a huge fan of having an artificially exaggerated team slide. You know, if you don't know who they are, you don't have the fill in the blank boxes that, you know, once we've had a close, we will add the name or they've been discussed. Only if it's a senior enough person to bring credibility, they've got the track record, they've got the firm backgrounds. That would be my 5 cents. Sajin, what do you think on that?
I agree to a certain extent. Maybe let me back up. I would say there is a pre first close and post first close momentum builders, and I'll call them momentum builders. I would say actually, I would say this: you need 2 partners, and the partners can take most of the entrepreneurial risk on there. If it's just one partner and no team, forget it. Especially in this current environment. So if you have 2 partners and those partners have had meaningful work experience together, if not at the same firm, you know, along those lines. What I actually think the most important thing is having all of your service providers and your back office ready to go. And, have your legal counsel, your fund administrator, who's going to be basically serving as your CFO controller, whether or not, that's the fund administrator services or you've identified, outsource that. But you need to be able to go when I always say this, you'll get one chance to make a first impression. And they want to make sure that this is a business, not a business concept.
Yeah.
LPs are not in the business of backing concepts. They'll meet with you. They might say, great, come back on it. But this has to be a business. So that means that you got to have all of your ducks in order in terms of if you got capital, you can manage that capital. So that's both on the investment side, that's on the back office side, that's on the reporting side, that's on compliance, cybersecurity. A lot of that could be outsourced in today's world, and that needs to be ready to go. I would agree with Brian. I'm not big on having a lot of window dressing. I actually think the most important next hire after you have your back office services, is that actually a principal level as opposed to an associate or an analyst, because it helps two things. It helps mitigate truck risk, meaning what happens if something happens to one of the partners.
Fair.
It also shows no one's investing in your fund for one fund. They're investing in your fund hopefully over 30 years.
Right.
They want to know that there's the ability to grow and continuity. So if you have the ability to bring on a principal level, and I'll let Lori describe the descriptions of what's a principal level in terms of experience, but that individual should also be able to take a little bit more entrepreneurial risk than someone that's 2 or 3 years out of it. Going to David's comment, and look, this is a startup business and people have to take entrepreneurial risk.
Right.
Unless the partners are independently wealthy enough to fund it. Now, there's opportunities to get seed financing. There's opportunities to get working capital. The whole ecosystem has changed where you can do that. But that just like any other startup, requires dilution. But I would say get all of your service providers, your back office, and the last thing I want one of my clients to tell is, oh, we'll do that when we can, or along those lines. You got to show that you're running a business.
Yeah.
Yeah, it's true. It's such a balancing act, right? You need that person, you need the principal, you need the years of experience. That's helpful, but then you got to pay them.
Right.
So do you have the management fees? Do you have the funding that you can pay that kind of a salary? Because that person may be entrepreneurial, but they got to feed their kids. So it's hard.
And then going back to a comment that Lori and David said, I actually think one of the most important people that you can need to talk to and interview, and this creates all sorts of different dynamics, is the people you're bringing on significant other. I know that when I started my firm, and we started on a bootstring, 20 some years ago, there was a little disconnect on how much entrepreneurial risk people who want to join us and their significant other was willing to take.
Right.
And we had some interesting experiences when someone's bringing in half the salary that they thought they were.
Right.
Yeah.
And so, again, in today's world, I don't know from a HR what you can and can't do, but hopefully we're talking about partners and principals. Again, you're talking about more of a close knit, and you have that ability. But I think that's just very important. You have to understand the forces on going through, whether it's this, the psychological review or the fit. That's all part of it.
Right. Or a lot of dinners.
Exactly.
As families.
Yeah. And this is when you're starting a firm, this isn't just you have decided, as we have been saying, to take an entrepreneurial risk. You're no longer just working a job. So yeah, I don't need to know who Rustin's boss is, but he knows Helen, certainly. And so it's one of those, when you're taking the risk and you're starting something, it becomes more about, family suddenly has an extended meaning in a certain way. Jabbar, you just
I was just going to say I couldn't agree more with Sajjan's comment, because marriage is a partnership and partnership is a marriage, right? So you all are in the same boat rowing together, and to make sure that everybody's on the same page is hugely important. And so a little too inside baseball, but we've been lucky enough that our respective significant others have been able to put up with our the ebbs and flows of all of this, and you know, we continue to trudge forward. So it's it is important, and to that end, you know, we as partners have the ability to fight like an old married couple, and laugh at each other's, you know, idiosyncrasies, but in a good-natured way, such that, you know, no one gets their back up, and you know, we can take criticism and keep moving forward. Less so in our respective marriages, but you know.
And having met Jabari and Ken in person, I have been like, how have you guys not killed each other? I'm glad that assessment turned out so well. But no, it's so interesting that you say that, because I actually have thought about doing, well, you know, a session for GPs to make sure they have a solid partnership, but also because this is very much a family affair. So I'm like, not to say that I need to become like, you know, one of those like relationship coaches who does retreats in Punta Cana, but I could certainly think about it.
But I actually think this conversation is really important at the very beginning, and then I'll say for the partners who want to go start, this is serious business.
Yes.
And you know, so many times I've got people calling me, you know, I'm not ready to leave my job, and you know, I want to raise the fund, and you know, can you raise the money, and you know, I can do fundraising on the side. And I'm like, wait a minute, guys, you know, you're creating a brand new business, and everybody who's going to back you, whether it be your LPs, everybody wants to know you're 125% committed, like any other entrepreneur.
Right.
You have to take financial risk, you got to take career risk, you got to take all those risks, and actually, very importantly, you have to do a self-assessment on whether or not you bring something unique to the table that an LP needs or wants.
Right.
You don't have the experience, the track record, the ecosystem, the know-how. This is brutal stuff.
Yeah.
And you know, so many times I have seen would-be private equity GPs, and I would say would-be because they're not willing to put the commitment and dedication and take the risk it takes to create a new firm.
Right.
And the world does not need another middle market buyout fund or venture fund. The world does not need them. In fact, we'll see a lot of them disappear. The world needs somebody that is uniquely talented, capable, you know, experienced, that can do something that is not available today in the marketplace.
Yes.
And that requires a lot of self-assessment, you know, and other resources to help you do that. And if you're not willing to dedicate 2 years of your life and a significant amount of your net worth, depending on what your net worth is,
Yeah.
to risk this, then it's probably an endeavor you shouldn't undertake. And you know, I'm just being tough love, brutal honesty. When you have over 3,000 GPs and you know, and more by the minute coming,
Right.
this is serious business. And anybody who wants to launch a first-time fund, especially if they're not spinning out of an existing fund with groups backing them. There's a big difference between spin outs and, you know, coming new into the industry. I was gonna, but I think everybody understands what I'm saying, and I would suggest that you talk not only to your spouses and others, but very significant, you know, mentors and other advisors, and make sure you're getting good advice and good assessment of, you know, whether or not what you're offering is something really special to the marketplace.
Yeah, and you know, the last thing that I would raise also, I totally agree, and some of you have heard me say this before, but I mean, there's that expectation, be realistic about it, that, you know, as a first-time manager, you're going to be rejected more than you've ever been rejected in your entire life combined. I mean, everyone who launches a firm is a hugely successful individual from preschool all the way through their jobs. Everything that they've applied for, they've succeeded in. And as an emerging manager, you will be rejected probably over 95% of the time. So you really need to look in the mirror and have those conversations with your spouses, as Sajin said, and understand that this is going to be a challenge to your psyche, challenge to your ego, and be prepared for that.
Yeah. Good point.
I
have a
know we normally go to breakout rooms, but I'm sorry, Rendell just put a very good question in the chat. It seems as if emerging firms, especially diverse, have this added pressure to create something unique that's never been done. What's wrong with starting another good investment firm, even if everyone else is doing it? every new firm isn't doing something new and they shouldn't put extra pressure on themselves. But that is a very good question. What's wrong with starting another good investment firm, even if someone else is doing it?
I
I would
apologize.
agree.
Go ahead.
I would agree with Rendell's question from a guy who is getting ready to break through. And my vehicles is real estate here in Texas, where everyone seems to be wanting to move their tech company to. You know, people have asked me like, okay, well, what are you going to do, you know, if I cut you this check? And it's like, man, look, you know, Samsung's building a $17 billion microchip plant, you know, just outside of Austin. I'm going to build houses and turn them into rental properties, and you're going to get way more than what you expected back. Or Facebook's building a data center in Temple, Texas. So to his point, you know, I think sometimes, especially in this day and age where everyone's always trying to, you know, remake the wheel, I think sometimes we need to understand that the wheel works. And, you know, if you just kind of follow the blueprint for the most part, you will have a successful vehicle that makes sure that everyone is compensated properly. And things there will be the least amount of headaches involved, right? I mean, obviously there's always something that comes up when we're talking about this amount of money, but I love it. Like, let's not try to overthink things sometimes. And I'm working on a project right now, and I had to tell the guy, like, hey, don't overthink it. Like, this is real estate. This is, you know, people have to have somewhere to live. These tech companies are going to need somewhere to put their workforce. Like, do the math. It's not that difficult.
I agree with that, and I think the thing that that Sejan and Tom, oh my God, Sejan and Thomas, because that's your name that I'm looking at. Sejan and Brian are saying is one of the things I actually put in one of my videos is that yes, differentiation of strategy is very important. The only thing is, especially from the purview of an LP and as a former LP, in my head, all GPs, you all do the same thing. Like, yes, you do it in different places, you do it with different types of companies, you do it in different asset classes, you all do the same thing. So if I'm seeing hundreds, maybe thousands of you, but I only have so much money to allocate, I got to kind of figure out what the different, you know, something in my brain has to say, okay, that's where I put the money, because I can't, unfortunately, give you all money. I mean, I'm sure Oprah could, but we haven't warmed her heart quite that much yet. But like Rendell just said, the differentiation is the people, which is both a wonderful thing and can also be a little bit problematic. The problematic part being the fact that, yes, unfortunately, we have seen that women, people of color, haven't always gotten as much capital as everybody else. The wonderful thing is that ultimately makes differentiation pretty easy when you're actually just being who you are. And I was talking with a client about this earlier and saying, you know, even in the way that you're moving in a meeting, like how an LP can read how comfortable you are in the chair that you're sitting in, because they've seen so many people sitting in those chairs that they can just see right through it. And so much of this business, yes, it's quantitative. This is finance. Absolutely. We love numbers. We all love numbers. You happen to have chose the people end of the business. And with people, there's intuition. And at the end of the day, that's ultimately what is making the final decision. Conviction is actually a measure of intuition. And if people can't get comfortable with you, that's going to strike that intuition, and it's not going to build the conviction. And so, Brian, so John, am I right? Am I wrong? Preach. We have 8 minutes, and apparently we're not going to get to breakout rooms. That's okay. This is the point of this conversation. The point of the Emerging Manager Roundtable is to facilitate conversations like this anyway.
I agree. Actually, I think you know, the way I would solve a problem may be different than the way Brian solves a problem, may be different than the way you solve a problem.
Right.
And so, or create value, or pull levers within a distinct within my portfolio company to create value. And then, you know what, maybe I then sell it up to another PE shop or strategic. And I think that's, while we may be playing in the same, what I'll just generally call pool,
yep,
the same strategy, the way we address things creates that differentiation of alpha for underlying LPs. And so I think if you look at differentiation, it takes many forms in terms of whether it be your strategy, quote unquote, on the headline, but who's sitting in the chairs also creates a differentiation within the strategy. So
Absolutely.
Yeah, I mean, there's no question about it. And, you know, I've always joked that the two words that LPs hate hearing the most are proprietary and unique. And I think LPs probably see 1,000 decks that say, you know, proprietary deal flow. It's always there. The reality is that nothing is really proprietary, nothing is really unique. What is unique is the team experience and the individual's experience. And in fundraising, which is where I've focused a lot of my time over the last few years, it's really the GP's ability to create a story and the narrative. And that is the differentiation. That is what will separate you from the 30 other lower mid-market emerging managers that the LP has met in the last month. How you source your deals, how you add value to the deals, what your personal background led in your experience to find you those deals, to connect with the entrepreneurs, to really add that value. It's creating a concise story. And it's important, I think, to remember that LPs are people as well as institutions, and you need to connect with the people. So you've got an institution that might have a mandate, that might have a requirement, but if you can't get through the gatekeeper and you can't give that gatekeeper a tangible story that they can sell internally, you're not going to succeed. So it's truly in the crafting of the story, and each of us craft our story differently. And it's important to recognize that.
I would add, let me first apologize if my comments were taken to suggest that you had to create something new. I think Vonetta used the word differentiation, and that's probably where we should. I agree with Ryan also. I very much believe in the KISS principle, keep it simple, and going to articulating it. But understand, we are in a hyper competitive market. Even in the emerging manager space, we're in a hyper competitive manager. And so you really do have to differentiate yourself, whether it's your experience, your sourcing, your approach, even though it might be, the same toolbox, right? And how you do that. We're in the middle of raising a fund with an emerging manager. They're using all the same tools that any other middle market. They're just applying it into an underserved market. And they have the real unique ability to communicate that and to demonstrate some experience in that. And that goes all the way. And I would say, piggybacking on Brian, especially for an emerging manager, you have to find a champion within the organization. And what we have always found, we have raised now for 23 years, emerging manager and other, first time and second time funds. Once you're able to get a champion internally, they will move mountains for you and doing that. But, that is a personal connection. That is a corporate connection. It could almost be a spiritual connection at some level, but that champion or champions internally will do a lot of the blocking, tackling, and it's amazing how many exceptions to the rules we find organizations do when there's a champion and you're able to convince them that what you're doing is truly special. And I'll use the word special. Brian doesn't like unique, and so. And that it can meet
Taurus next time.
and it can meet, the various objectives of the organization and the individuals. And I will tell you what has changed in the last 3 years, where 100% before was returns. Now we have returns with some other, what I'll call softer mandates and importance that I think the world is realizing is critical to actually keep maintaining those good returns, right? And so, finding that champion and getting that champion internally is huge, especially for an emerging manager.
Well, this was wonderful. I mean, we have 3 minutes left, so I'm obviously not going to ask Helen to send you into breakout rooms now because that would be ridiculous. I basically want to say thank you very much to Lori for being our champion of building very strong teams and for giving us so much wisdom into how we do that and how we can do that on a more inclusive basis too. So thank you, Lori, so much. And thank you
for
all.
having me. Thank you. Thanks for joining, everybody.
Absolutely. And thanks so much for the great comments, everyone. This was just a absolutely just wonderful and dynamic conversation. And it is very much the reason why I started the roundtable, not just to give people knowledge about fund formation, but to have the conversations about things that, you know, you might not be talking about already. So this is the last Emerging Manager Roundtable before summer break. So we will have July and August off to, I don't know, hang out. I'm going to start writing again. My baby will be a year old on July 11th. And I said I wouldn't bother with doing any writing until he was a year old. So I'm going to take a week to go somewhere. Actually, I'm just going to Rockville. I live in DC and one of my friends has an apartment in Rockville. And I was like, fine, I'm going to Rockville to write. So I wish you all a very lovely summer. We will be back in September. And so the back end of the year, things get really spicy. We're going to have our placement agent friends and our anchor LP friends and perhaps someone from the outsourced IR space. And I'm still working on that one, but really still moving through the process of fund formation to make sure that we're answering all of your questions and you got all the resources that you need to succeed. But thank you again all so much for being here today. Thank you to the old hats, to David and Brian and Sejan and Laura. Thank you to the old hats who keep showing up. And so looking forward to seeing you all at the back end of the year. Have it very nice chance this summer. And I'll see you in September.